Welcome to this explainer. Look, I am absolutely thrilled you're here today because we are stepping into the high-stakes, intensely rigorous world of global financial reporting and auditor regulation. You know, whenever you look at a company's financial statements, or whenever some massive corporation makes a market-moving claim about its profits, there's this entire hidden architecture working behind the scenes. It's there to make sure those numbers are actually telling the truth. And today, we are illuminating that exact architecture. We're pulling back the curtain on the International Federation of Accountants, or IFAC, and the global auditing standards that literally keep our financial markets stable.
Okay, let's dive into this. It really starts with a simple but honestly profound question. Who regulates the regulators? We all know external auditors are the ones double-checking the math for these massive corporations, right? But who is checking up on them? Auditors wield incredible power, and they have to be strictly regulated for two very specific reasons. First, they've got to maintain uncompromisingly high standards of work. And second, their reputation with the public has to remain basically unshakable. I mean, think about the major corporate scandals of the past. If the public loses faith in auditors, they kind of lose faith in the financial markets entirely.
So, how exactly is this global trust maintained? Well, here's our roadmap for today. First, regulating the auditors. Second, IFAC and the public interest. Third, decoding the standard-setting boards. Fourth, the authority of ISAs, and finally, how these standards are actually developed.
Let's kick things off with Section 1, regulating the auditors and the mechanisms of control. It's super important to grasp right out of the gate that the regulatory environment for external audits is usually baked directly into national law. It's not just some good idea, it is a strict legal requirement. But here's the thing, just having a law that says you must do an audit isn't nearly enough to guarantee quality. To get true reliability, the industry uses a multi-layered approach. Think of it like a 6-layered safety net. First up, you have the statute itself, the foundational legislation. Then you've got strict licensing requirements, like needing a practicing certificate, which proves you actually have the legal right to do the job. Next are the competence requirements. Think professional qualifications and ongoing, continuous education. On top of that, we add professional conduct rules that govern behavior, and then the actual auditing standards that dictate exactly how the work gets done. And finally, if all else fails, there are severe disciplinary procedures enforced by professional accountancy bodies. It literally takes all 6 of these mechanisms working together to keep things in check. Moving right along to Section 2, IFAC and public interest, the global architect.
Let's meet the organization that presides over this whole ecosystem. The International Federation of Accountants, or IFAC, is just a fascinating entity. It's a nonprofit, it's non-governmental, and it's totally non-political. It doesn't represent just one country or one government. It represents the profession on a planetary scale. And to really give you a sense of that sheer scale, just think about the number 180. IFAC's membership is made up of over 180 professional accountancy organizations spanning across more than 130 countries. So when IFAC speaks, they are representing literally millions of professional accountants worldwide. They are the unified voice of a massive global profession. So the crucial point is, why does IFAC even exist? Well, their core mission is to serve the public interest. Now, I know public interest can sound like a bit of a corporate buzzword, but here it has a very specific foundational definition. It means the values and principles relating to the public good, or what's in the best interests of society. Every single standard they develop, every practice they promote, and every time they speak out on global issues, it's ultimately to protect you, the public, and to make sure society can actually trust the financial bedrock it operates on. To pull off this massive vision and be a real leader in developing sustainable financial markets, IFAC leans heavily on 3 guiding values: integrity, expertise, and transparency. Every council, every board, committee, volunteer, and staff member at IFAC tries to exemplify these 3 pillars. Because think about it, without integrity, the numbers mean nothing. Without expertise, the numbers are just wrong. And without transparency, well, the numbers are completely hidden. All right, on to Section 3. The 4 standard-setting boards. It is time to decode the alphabet soup. Now, what's really interesting about this setup is that IFAC doesn't just sit in a giant room and issue decrees. Instead of having one massive, slow-moving committee trying to tackle everything, IFAC delegates the standard setting to 4 distinct independent boards. You've got the IASB, focusing strictly on auditing rules, the IESB, handling the moral compass and ethics, the IESB, focusing on the human element and training, and the IPSASB, tackling the unique beast that is government reporting. Let's look at each one a bit closer so they don't just blur together in your mind. First up, the International Auditing and Assurance Standards Board, or IASB. Their main objective is absolutely massive:
creating a globally uniform standard for auditing and assurance. Imagine for a second if every country audited financials completely differently. Global trade would be a total nightmare, right? The IASB works to fix that by issuing really powerful pronouncements, most notably the ISAs, which we're going to talk about in just a second. Basically, they want an audit in Tokyo to mean the exact same thing as an audit in Toronto. Next up is the IESBA, the International Ethics Standards Board for Accountants. They protect the public by drawing the hard ethical lines in the sand. You can think of them as the referees, making sure the game isn't rigged by shady financial ties or conflicts of interest. Because let's face it, an auditor simply cannot be truly objective if they're somehow tied to the client they're auditing. The IESBA is continuously monitoring and sparking debate on ethical issues to make sure accountants are actually living up to the strict expectations of businesses and financial institutions. Then we've got the IASESB, the International Accounting Education Standards Board. Look, standards and ethics are great on paper, but they are totally useless if the people executing them don't actually know what they're doing. So this board focuses heavily on the human element. They provide the research, the guidance, and the information exchange to ensure accountants worldwide have the proper training and educational foundation to actually meet their immense responsibilities. And finally, to round out our board breakdown, we have the IPSASB, the International Public Sector Accounting Standards Board. Governments obviously operate a lot differently than private corporations, so the IPSASB's unique focus is on improving worldwide public sector financial reporting. They do this by developing international accrual-based accounting standards specifically tailored for governments and other public sector entities. That brings us to Section 4, the authority of ISAs and the strict rules of engagement. So we mentioned the IASB a minute ago and the incredible documents they produce, the International Standards on Auditing, or ISAs. These ISAs are basically the mandatory playbooks that let an auditor confidently express an independent opinion on financial statements. But we really need to clarify a super important legal hierarchy here. By their very nature, ISAs require auditors to use deep professional judgment when applying them across all sorts of diverse scenarios. However, while ISAs are globally vital, they still have to coexist with national legislation. The requirements of the ISAs absolutely do not override local laws or regulations. They have to work together. And this creates a really interesting tension. And this brilliantly illustrates the golden rule of auditing. You cannot treat the ISAs like a buffet, where you just pick and choose the rules you find convenient. It is an all-or-nothing requirement. To officially claim compliance, or to state in a final report that an audit was conducted in accordance with international standards on auditing, an auditor has to apply all relevant standards, no exceptions. Even if national regulations were followed perfectly, if relevant ISAs were bypassed or just not applied in their entirety, the auditor absolutely cannot claim ISA compliance. Period. Now, yes, the rules are incredibly strict, but they aren't entirely blind to reality. Sometimes, an auditor might run into exceptional circumstances, where following a fundamental principle might actually stop them from achieving the standard's true objective. In those highly unusual cases, an auditor can use their judgment to depart from an essential procedure. But listen, it is not a free pass. That departure must be strictly, thoroughly, and rigorously justified and documented in the auditor's working papers. The burden of proof falls entirely on the auditor to show exactly why breaking the rules served the ultimate goal of finding the truth. Finally, Section 5, developing auditing standards. It's a living process. Let's move on and see how this all builds. How exactly do these crucial rules get brought to life? Well, the development process is incredibly meticulous. Step 1 is project identification. Ideas for new standards, or revisions to old ones, don't just appear out of thin air. They're actively pitched by IASB members, advisory groups from the business community, national standard-setting bodies, and groups like the Forum of Firms, which is an independent association of international accounting networks. Once a project is identified, we hit Step 2, which involves assembling a dedicated task force. This task force dives headfirst into deep research. And finally, Step 3 is the exposure draft, or ED. This is essentially a public draft that gets put out into the world for scrutiny, debate, and feedback long before it ever becomes a binding rule. Which brings us to the end of our explainer. We've looked at the multi-layered statutory mechanisms, the massive global footprint of IFAC, the precise roles of the 4 distinct standard-setting boards, and the unyielding all-or-nothing authority of the ISAs. So, I want to leave you with this provocative thought. If absolute, rigorous compliance with these global standards is the bare minimum required for an auditor to officially claim they've found the truth, How confident are you in the financial data that shapes the markets, the businesses, and the world you rely on every single day? Knowing about this incredible machinery working behind the scenes to protect the public interest should definitely spark your curiosity to dig even deeper into the financial world around you. Thanks so much for joining me for this explainer, and I will see you next time.